This trade I just entered may be the easiest money I will make in the stock market. If we go ahead and jump into my monitor window, you will see I am short a Google put. I am short a cash secured put on Goog. I'm looking to bet that Google will not get to $96 by October 21st when this option expires. And then if it does, there's more that comes to this strategy after that we will get into. It's called the option wheel strategy. It's definitely not something I invented. The strategy's been out there traded pretty much since the beginning of options. Is one of the more simple option strategies, but oftentimes the simple strategies are the best ones. So hit the like button if you're excited for it. Hit the red subscribe button if you're new, and let's go ahead and jump back into the monitor window. So as I said, I am short one put, -1, short a put at a 96 strike that expires on October 21st on Goog. What does that mean? If you're longing puts, if you're buying puts, that means you think the price of the stock is going to go down, right? I'm shorting a put, so obviously that means I'm betting that the price won't go down. I'm betting that the price won't get down to $96 by October 21st. I don't even need Google to go up. I just need it to not get to 96 by October 21st. Therefore, and when that happens, if that happens, I will collect this premium for free. I have a $240 position. I will collect all this premium for free if on October 21st, Google expires above $96. Well, what happens if Google does expire below $96? Guess what? I still collect that premium. As long as I let this option expire, meaning I don't exit it, roll it out before October 21st, that $240 is already in my bank account. It's my money as long as I let that happen. But if it expires under 96, say it comes down and expires at 90, 92 and a half, 93 on October 21st, I then I will collect the premium, but I'm forced to buy 100 shares of Google at $96 because I'm short one contract and each contract represents 100 shares. So that will be what happens if we do expire below 96. But what's the next part? Okay, Trey, well, that would suck. You would obviously lose money in that situation, wouldn't you? Yes, you'd collect the premium, but if it's trading at 93 and you have to buy it at 96, that's $300 down. So then what would you do? The next part of this, the wheel part of this, so I just explained cash secured puts to you, right? By the way, cash secured puts, meaning you will be able to do this. If you're watching this video like, well, I'm not approved to sell options, so I'm just going to leave. None of this matters to me. Cash secured puts are different. This is not a naked put. I can only lose the amount of money. Like if Google goes to zero, I'll lose $9,600 because that is what the valuation of the contract is, of the underlying is $9,600 and 96 strike put. So it locks up that cash in my account. It takes $9,600 of buying power away from my account minus the premium actually. So about $95.80. I don't think I did that math right, $94.80 out of my account, and I can't use that buying power anymore, but I also can't get margin called, right? The brokerage knows I have the cash in my account to pay for the worst case scenario, so it allows me to take the trade. You need very low level options clearance to be able to take this trade, to be able to short cash secured puts and covered calls, which is the next part I'm about to get into. So what would I do if I do end up having to buy 100 shares of Google? I would then come in, okay, October 21st, we expire at $95. Crap, we expired below 96. I now own 100 shares of Google at 96, and it's trading at 95. Well, I would immediately wheel this, and I would go look at November 18th calls. I would now look to sell covered calls against the position that I own. So what is this doing? What's the whole idea here? The idea of a wheel option strategy is you look to collect premium on both sides of a move on a stock that you want to own long-term. Now, that last part there is very important. Be very careful doing this. This can get ugly because, it can happen where the stock is going to get crushed. Google on October 21st is trading at $85. I'm down $1,100 because I have to buy it at $96. This can get ugly, but I'm doing it with Google, right? I'm doing it with a stock that I wouldn't mind owning long-term at 96. If you offered me 100 shares of Google at 96 right now, I'd take it. I would love to own Google at 96. I'd be perfectly happy owning Google at $96. Google is my favorite stock in the stock market at current valuation. So it's fine with me if I get filled. I get to define the price that I want to own the stock at, right? I want to own Google at 96. So I sell a cash secured put. And then if it doesn't get there, if it doesn't get to 96, I just make this $240. Yay, cool. I just make the $240. If it does, I collect the $240 anyway, and then I just own Google at 96, which I'm perfectly comfortable with anyway. And then once I own it, I can come sell calls in the exact same way I explained how selling puts work, selling calls work as well against your position. I can come sell a call against the position that I own. That's the wheel option strategy. I want to touch on a couple more examples and important topics though. Why did I pick 21st of October? I go a month out. I just think a month out is a good place to be for this. And why do I go a month out? That's because of theta. If you don't know the options Greeks, there's a handful of them, but theta is how much an option loses overnight. Every day, the option is going to lose $7. So I go a month out, I get to collect more theta. I get more time decay in my option by going a month out, right? That's why I pick a month out. And then why did I pick this strike price? I like to pick around a 30 delta. If you don't know what delta is, every point that the underlying changes, the delta is telling you how much your option will change. So Google's currently trading exactly at 100.5. If it goes to 101.5, my option is going to change by 30 cents, right? That's what I look at in the Greeks for when I'm looking at my positioning. Now, another important topic is that implied volatility is high right now, right? The market just overall is very volatile right now. Implied volatility is pretty much up everywhere because the markets are dumping off right now. But that's another good time. Implied volatility is another extrinsic value that gets baked into the option. If you want to be collecting premiums, you want to be selling most expensive options you can realistically, right? To collect more of that premium against your bet. So right now the implied volatility is high. And you can kind of just know that. You'll just realize that from how fast stocks are moving. But if you need it measured, I have a tool here. This is marketchameleon.com. And no way am I affiliated with them. And yes, you will have to make an account to use this tool, but it's free. You can make a free account, sign in, email, password. You'll be able to use this. I'll link it in the description down below. But as you can see, the blue line represents the IV, the implied volatility, and the purple line represents the historical volatility moving average. So right now, volatility is up above the historical volatility. So volatility is higher than usual right now. Good time to be selling options. So we went in, sold a cash secured put, looking to collect this premium. We are going to collect this premium. And then on October 21st, we're either going to own 100 shares of Google or we're not. If we do, we own 100 shares of Google at 96. Great. That's a fine place to own Google. And then I will start selling covered calls against that position. So that's an option wheel strategy. It's a very simplistic. I mean, we're riding a bike with training wheels right now when it comes to options. You can get way more complicated than this. We're playing T-ball, but it's very simple and it's pretty easy. Once again, as long as you're doing it on stocks, this can get very complex and it can get very scary. You start doing crap like this on like GameStop, Best Buy, your crappy little penny stocks. But as long as you're doing it on stocks that you want to own long-term anyway, it's just collecting free premium on top of where you want to buy the stock anyway. If I want to buy 100 shares of Google at 96, don't just sit and wait for it to get to 96 and then go buy 100 shares. Why not do this? Why not sell a cash secured put? And then once you're in the position, why not look to collect some more premium with a covered call? Go sell a 107.5 call. And then wherever you're looking to sell your shares of Google, why not lock in extra premium profit on top of that as well? So that's the wheel option strategy. If you guys have any tips, tricks, you guys are pros of this strategy, let us know in the comment section down below. Check out the comment section down below to look for tips and tricks down there. With that being said, hit the like button if you enjoyed this video. It really does help. Hit the red subscribe button if you're new. With that being said, I'm going to go ahead and sign out of this video. I will catch you all in the next one.